everyone. I promise I won't keep you too long as I know everyone needs coffee. So my name is Meaghan Johnson, and firstly I'd like to give a huge thank you to ECO, Portugal Fintech, as well as the Fintech House for inviting me here today to share my insights on embedded finance. We kicked off the event today hearing about some real applications, use cases of embedded finance. We'll continue to hear about some of these use cases today, and immense credit is due to all of the players within the embedded finance ecosystem, because this ecosystem is filled with tensions. And my keynote today will be talking about these various tensions within the embedded finance ecosystem. So first, just a very brief background about me, why I'm here, why I'm talking to you about these tensions. So my name's Meaghan. I'm based in central Portugal, outside of Coimbra. I've been working in banking and digital financial services for about 12 years now. So started off agency side, working with incumbent banks in the very nascent mobile banking and fintech space in 2012, supporting them in product and channel development. I then co-founded 11FS, where I built a customer insights portal called Pulse and worked on a couple digital banking greenfield projects with some of the big UK banks. And since 2017, I've been a solopreneur, so working with a lot of different players within the fintech and digital banking and insurance ecosystem. And especially over the past couple of years, I've been really fortunate because I've been able to work with, every player involved in the embedded finance ecosystem. So a handful of regulators, some of the enablers like Solaris, ConnectPay, Railsbank, some of the brands, the consumers of embedded finance, so both fintechs and digital brands, as well as spending a lot of time speaking to consumers, so the end users of embedded finance, and how these needs are or maybe are not fulfilling their needs and their jobs to be done. So over the past couple of years, I've seen a lot about embedded finance, specifically the tensions as well as the benefits that it brings. And just to give a bit of context about embedded finance, so embedded finance is here to stay, and this is a good thing, and I think everyone here in this room agrees with this statement, or else, quite frankly, you wouldn't be here today. And embedded finance has been a huge benefit for consumers, producers, for everyone involved in financial services. And for those of you who were here a couple weeks ago at the Visa Innovation Program, what I'm about to say probably isn't new, but I believe embedded finance is a catalyst for mass disruption within financial services. So because of embedded finance, we are at the cusp of the Uber moment, the Spotify of banking moment within financial services, as well as the insurance space. And just to touch upon some of the benefits that embedded finance brings to various players, specifically the consumers of embedded finance. So if you are a fintech startup, the primary benefit of embedded finance is that it removes the need for high upfront investment costs. There's a bit of a... So it's okay, no problem. High upfront investment costs and allows fintech startups to do what they do best. Build customer-centric, low-cost products, iterate quickly, and find product market fit quickly. So if you are a fintech startup, you use a bank as a service provider or an embedded finance provider, and this removes a lot of the resource and investment costs with licensing, with building your own infrastructure, with capital requirements, again, allowing you to use these often finite resources in a way that allows you to work quite agile and find product market fit. From the brand perspective, so embedded finance removes this need for deep financial services knowledge and experience, also licensing requirements, and allows brands with loyal customers to open up new revenue streams, funding options, and increase customer loyalty. So if we think about a construction tech company, chances are they don't have, a team of people with deep experience working within banking, financial services. They realize the value of embedded finance, and by, outsourcing this to an embedded finance enabler, they don't have to hire that team within. They can piggyback off the knowledge of the embedded finance enabler to make sure that they're launching, a strong embedded finance solution. And something I think that's often not talked about enough is the operational efficiencies that embedded finance can bring to brands. So we see things like virtual accounts, embedded payments, providing for better reconciliation, and more efficient kind of payment mechanisms. Okay, so let's get into the tensions. So I looked up tension in the dictionary and came across this definition, which is a state of latent hostility or opposition between individuals or groups. And I think kind of hostility may be a bit too strong of a word in this definition. But again, having spent the past couple years working in this ecosystem, I can 100% tell you that there is tensions between the different players in the ecosystems. And, it makes sense that embedded finance is filled with tensions because it has upended hundreds of years of how banking works. So with embedded finance, we have seen the way financial products and services are produced, consumed, accessed, and distributed totally change. And this is why we start to see these tensions between the various players in the ecosystem. So the first tension deals with the customer experience and the customer expectation. And when we tend to think about, customer expectations not being met within the embedded finance ecosystem, I think we all probably think of the Apple Goldman Sachs example, which kind of hit a tipping point last year with the launch of the Apple Savings account, which was powered by Goldman Sachs. So you are a customer of Apple, you are a highly loyal customer. Apple provides you with the best customer experience, the best customer support, the hardware, the OS, everything about Apple is fantastic, right? And now all of a sudden, you can access this high-yield savings account provided by Goldman Sachs, and all of a sudden you want to withdraw your funds and it's taking 4 days, 5 days, a week. You're quite frustrated because this isn't, what you expect from an Apple product. You then reach out to customer support and you are dealing with a very grumpy Goldman Sachs customer support agent, not the same level that you would expect from, Apple customer support. So here we have a mismatch between what Apple customers are expecting and what they're actually receiving from their Apple savings product. Another example, so we talked about Uber and kind of the embedded payments aspect of Uber. But I think a really interesting case study from Uber. So in Nigeria, they partnered with a vehicle-based financing company called Move to embed vehicle-based financing within the Uber platform for their drivers. And what happened, there was some macroeconomic shocks. The price of petrol skyrocketed in Nigeria, and a lot of these Uber drivers could not meet their monthly repayments. And as a result, their cars were subsequently impounded and taken by Uber and their embedded lending provider. So what started off as something that was meant to enhance the livelihood of the customers actually ended up hurting a lot of them. And you'll see here I have a screenshot of Spotify. Spotify, as far as I know, has not gone into the embedded finance space. But I often think about, what would that look like for Spotify? I'm sure everyone in the room uses Spotify, and Spotify is just amazing, right? Instant access to music, personalized playlists, personalized recommendations, music for our mood. And the customer has this very, very, very high expectation of what that Spotify experience will look like. Now, if Spotify, decides to embed accounts, lending, deposits, for example, there will inevitably be tension and friction, which will take away from that, loved Spotify experience. So with these big brands, with the big tech, with the super apps, with any brand, there is always, a risk that has to be considered, that when you are embedding a financial product or service, it will naturally provide friction and tension. And it's important to kind of mitigate this and keep this in line, with your customer experience. And just a note, which I'll touch upon a bit further, friction within financial services is a very good thing. We need friction here to keep consumers safe. Which leads into the second tension, which is the tension between the regulators and the suppliers. And I'm sure this isn't going to be a big shock to anyone. So the job of the regulator is to foster innovation and keep customers safe, keep their funds safe, oftentimes as well, with the fintech revolution, we start to see these fantastic kind of fintech hubs like in London and Lithuania and Singapore, where we have very forward-thinking regulators, trying to get fintech high-value talent into the ecosystem. And if you're a brand, if you're a fintech, you want to set up shop in one of these, hubs where there's a high level of talent and a very kind of friendly, innovative regulator. But regulators need to regulate. They're here, they're not going away, and they keep us safe. And 2023 was a year in which we saw a lot of increased regulation on embedded finance and bank-as-a-service providers. I'm not going to name and shame anyone, but across Europe, the UK, as well as the US, we started to see the regulator kind of really putting the brakes on embedded finance enablers, bank-as-a-service providers, to make sure that their AML, KYC, fraud processes are all in place and actually staying on the side of compliance. The third tension. So anyone that's worked as a producer, an enabler of embedded finance, and as a consumer, a brand, or a fintech, has undoubtedly experienced this tension. And this is the tension that the playbook for founders and innovators goes against the very nature of financial regulation. So as I mentioned, we have to have friction within financial services because this is what keeps the consumer safe. But oftentimes, founders of startups, innovators within brands, they have a mantra that is typically, move fast and break things, get shit done, living and breathing by the Nike playbook. And this, again, goes head to head against, that need to have that tension for financial products and services. So what happens when you are a fintech, a brand, and you want to start your embedded finance journey? You reach out to an enabler and you see, oh my God, this is amazing. There is this API that lets me launch my product in record time. And you have some really great salespeople saying, you can get up and running in a couple weeks, and everything looks fantastic. But I'm sure we have a lot of bankers in the room, and anyone that has worked in a bank knows that there is so much that goes on underneath that iceberg for maintaining and staying compliant for not just a fully regulated bank, but also, if you have an EMI license or any other, license from a local or the EU regulator. So things like compliance, capital requirements, AML, KYC, these are often kind of kept away from the consumers of embedded finance, the builders, the founders. So again, there will always be that tension between I want to launch my product in 6 weeks, I want to achieve that product market fit, but all of those things that are happening in the background due to the nature of financial services, again, being a highly regulated industry that needs that tension. And tension 4, this is a bit more philosophical. So this is about the future of the bank. Germain talked about the recent Solaris report, so when brands become banks, an interesting article from Swan saying that, banks are not the future of banking, companies are. I completely agree that companies and brands are the future they are the future distributors of financial services. And again, this is why embedded finance is so exciting. Banks will still be here. We will need banks. They will need to do everything underneath the iceberg. KPMG also coming out with a study finding that traditional boundaries within the financial services industry will disappear by 2030. So, in 2 years' time, 3 years' time, will we be accessing financial services from a mobile banking app, from a challenger banking app, or are they going to be more contextualized, more personalized in the brands that we love? So, to ensure embedded finance succeeds, these tensions need to be managed. They cannot be left as the elephant in the room. And the regulators, the enablers, the producers of embedded finance, and the consumers, the brands, and the fintechs need to work together to mitigate these tensions. So I suggest we move towards a different definition of tension. So instead of a state of latent hostility or opposition between individuals or groups, we move to a new definition, which is a balance maintained in an artistic work between opposing forces or elements. Thank you.